All right, a very good morning to you. Welcome to yet another episode of that is Financial Wellness brought to you by Absa Bank. My name is Jimmy Mbogo. I'm going to be your moderator and host through this webinar. Of course, you will remember that just not long ago, about 4 months ago, we were here and we were having a similar conversation looking at some of the tax changes that have happened in the country and how you can be able to plan for that going forward. And today is a continuation of that conversation. We want to help you prepare even as we look into the next financial year. What are some of the changes that are likely to come up in the next few days, and how will that impact your business? You will also remember that late in December last year, there were some changes that happened. We'll be talking you through what are the implication of these changes. Welcome to this webinar. As I said, my name is Jimmy Mbogo, but first, let us welcome, that is Sima D'Souza, who is the head of Affluent and Private Banking here at Absa Bank. And of course, she will be taking us through some of the elements that they're introducing to affluent bankers and to prestige customers like yourself, and what are some of the things that you can take advantage of in the coming days. Sima, welcome to the program. How do you feel, first of all?
Oh, I feel fantastic. Thank you. Thanks, Jimmy.
Great. Maybe you can just take us through some of the elements that you're introducing for prestige customers, and what can they look out for in 2025?
Okay, well, fantastic. First of all, I think, let me just also welcome our prestige customers to this webinar. It is, like you said, the second episode in the series that we've created for them. So thank you very much for dialing in from wherever you are, and we hope that the session will be, we know the session is going to be fantastically empowering for your financial wellness journey. So prestige banking, if I just go back to its origin, I look after the affluent business. The affluent business is basically the spectrum of customers who are in their financial journey at different stages of life. And so prestige as a segment sits alongside two others. So we have Premier and we have Premier Wealth. Prestige is our entry into the affluent business. And for me, it is probably the most critical segment, especially considering the stage at which prestige customers are in their life and the kind of guidance, nurturing that they need from their financial partner in terms of their growth. So webinars such as these are so critically important. I mean, if you think about what we went through as a nation last year, with all of the austerity measures, the tax measures that were implemented, Gen Z on the road, the exchange rate at what it was. There's so much that Kenyans went through. In fact, I was having a conversation just earlier talking about how resilient we are, that we actually just pick ourselves up and keep going. But what we would love to do is ensure that we're there at every moment to empower you with information, knowledge, tools, to enable you to navigate all of the challenges that are coming our way. So this is basically just an example of that, and there definitely will be more to come.
All right, so one of the things that we have seen lately from Absa is a campaign of this is essentially says this moment, own it. What does that mean? What is this moment that you want us to own?
I love this campaign. I'm in love with it, actually. This moment, Own It, is so special. And the reason why it's so special is, I'll just start off with, Absa holistically. And, we talk about your story matters. And let me just center the campaign on that. I think what we really firmly believe is everybody has a very unique story in their life. My story is so different to yours, Jimmy. You've just told me about your beautiful daughter. You're facing different things in life to what I'm facing. And it's really important for Absa to acknowledge that everybody's story is different. And so this campaign is really about ensuring that we're there at your moments of life. Everyone has critical moments. Your critical moment when you saw the video of the child being born, I saw your face light up. That's very real to you because it just happened. Whereas for me, my moment is my daughter's going to university in a couple of months, and that's a huge change for me. So everyone's moments are unique, and we want to make sure that as a financial partner, we are there to help you through thick or thin, because there are very thin moments as well that we've all experienced. To be there for you and plug in and empower that moment, and we want you to be able to own it, be it your first car, your first home, your first daughter, whatever moment it is that you're going through. So that's really what the campaign is about.
All right, so Sima, of course, and also just looking at some of our audience at the moment who are mostly prestige customers, there's the question of what is your commitment to them as an institution? There's some that maybe have just come on board and they want to know, what does this bank offer me, and what are some of the things that I can take advantage in the next financial year, in the next month? What are some of your products that maybe they should be looking out for?
Yeah, no, thanks for that question. I think so. So we relaunched this proposition in February this year, and we did it based on a lot of customer research, just understanding our customers, their needs, challenges, fears, ambitions, etc., and really centered the proposition around that. As a result of that, what we've done is we've reintroduced a proposition that is anchored around financial, mental, wellness, and ensuring that we're empowering you and your story to be able to deliver through a variety of different aspects and elements of the proposition. So the first thing that we have in place, which we didn't before, are prestige bankers. We have a team of prestige bankers that are really well trained, available at the branches, also within our contact center, to be able to provide you with guidance on your financial needs, have conversations with you that possibly nobody is having with you at this moment in time of your life. So having those conversations with your financial advisor or prestige banker is one of the elements. The other elements are really centered around ensuring that we're empowering your financial growth through things like extended lending limits, ensuring that we provide you with credit cards that are, again, empowering your growth at that particular moment when you need that support, but also at the same time, providing you with lifestyle benefits, because we're really cognizant of the fact that our prestige customer wants to enjoy life, wants to own the moment, wants to live their best life. And so therefore, we have partnerships through the card that will enable them to access a whole variety of benefits that they will then, I would love if I was a prestige customer as well, So that is the other thing. But also at the same time, ensuring that we're there for our customers in their time of need. So insurance is an extremely important part of the proposition. We have retrenchment cover that really helps, especially, in this tough time that we're going through. You never know what can happen. And it's so critical that we are there for our customers during this period. But in addition to that, obviously insurance that covers things like our snazzy gadgets that we have, home content and so forth. Remember, we're also here to power your firsts. So for us, what's an interesting, exciting product that we're really pushing is affordable housing. So mortgages that are so affordable, and property ownership is really one of the fundamental aspects of financial growth, especially within our prestige segment. So affordable housing entitles you to a mortgage of up to 10 million at a rate of 9.5%, significantly discounted and subsidized over a period of 25 years or retirement, whichever comes earlier. But what's so special is we've also kind of adjusted our criteria to enable you to borrow 110% of the home, and that caters to closing costs, caters to any furniture, etc., where you're setting up your new home. We really want to make sure that critical milestone is powered by ABSA Prestige. So that's one of the things that we brought in. In addition to that, we have newsletters, we have moments like this. We have so much that we've put in store for our customers.
All right, so I'm going to put you on the spot. And of course, I know even with our audience, they have the expectation, and the customers have the expectations of what it is that they want to get out of this conversation. So for you, Sima, what are some of the things that you want to get out of today's session?
Jimmy, it's very interesting you ask me this, because the last session that I dialed into, to be really honest, and Carol is in the crowd and she'll tell you, actually, as soon as it finished, I was like, oh wow, I didn't even know that tax has just been implemented. I didn't know that I could get that benefit. I didn't know that I could put this, this as an expense and things like that.
Yeah.
I think at the end of this, what success would be, especially for our customers, is empowerment with information, empowerment with strategies on how to navigate taxes, an idea of what the finance bill might have for us next week, and what it is that we can do to protect and cushion ourselves during this time if there's anything that adversely affects us. But essentially, it's just empowering our customers to have the information and the tools available to navigate tax and actually benefit, because like I said the last time, I was truly impressed that, oh, I can do this, and oh, I can do this. So actually I'm a much more aware individual around tax, and that's really what I hope that we can achieve for our customers today.
All right, and I think that's a good place to, in terms of just setting the stage. And as promised, of course, our guests are back with us, and they will be giving us insights into what we can expect in the next finance bill, and also which should be coming out in the next couple of days. And what does that then portend for you in terms of your spending, in terms of your disposable income, and what are some of the challenges that are likely to come even as we plan for 2025 financial year. But first, before we go into that conversation, as I said, our guests are already here with us, and they will be joining me on stage in a few minutes. But Sima, thank you so much for making time to speak to us. And of course, so let's have a look at this video in terms of what else the bank is currently doing for you as our Prestige customer.
When I started Icon in 2015, I kind of had an idea of what I wanted it to grow to. Now, fast forward 10 years later, I can only marvel at the massive growth and what we've become. From thrifted pieces to now 4 physical stores in Nairobi, retail outlets in Juba, South Sudan, and Ghana, and a thriving e-commerce platform. And not to mention the 99% all-women team at Icon, all made in Kenya. From putting money under my mattress and up the ceiling to banking with one of the most prestigious banks in Kenya, Absa Bank. From one starting point to multiple epic moments. 2025, you're going to be epic.
To Icon! Icon! Hey! Woo! DJ, take it away!
All right, and welcome back. Of course, those are some of the things that you even that the bank can also do for you as a business. But of course, before we go into our next conversation, allow me to just take you through our rules of engagement during this session. And as promised, our experts are already here, and they will be taking us through their presentation, during which time we hope that you will be sending in your questions. However, if you need a burning question that you need responded to, kindly just share it on the chat, and we will be getting them to respond to those questions that you will be raising. And also, if you have a question that is outside the conversation that we're having here today, we will be sharing a link or an email that you can raise these questions, and will help the entire team from Absa Bank address some of your concerns. Now, without much further ado, I want to go into our next part of this conversation. And as promised, James Mulili from PKF, that is the tax director at PKF, is already here, and also Kevin Chege, a tax manager at PKF, is also here with us, and they will be taking us through 3 elements through 3 topics that we have chosen to make part of today's conversation. And one of those topics is we'll be looking at the Tax Amendment Act of 2024. What are some of the changes that happened towards December? You will remember that these were passed on December 27th, 2024. And of course, that is a period that majority of us were out on holiday maybe, and just enjoying the festivities. What are some of the things that we might have missed? What does that portend for you, for your income? If you're in business, what does that mean for you? We'll also be looking at the Tax Procedures Act that was also passed around the same time, and what that portends for us, even in terms of our liquidity, in terms of our expenditure, disposable income, and what are the benefits, if any, that will be that came with that. We'll also be looking at some of the key areas that we should be on the lookout for in the next finance bill that is expected to come out in the next couple of days. What are some of the areas that they think we should be on the lookout for? What are some of the key things that we need to do to prepare for that? And of course, as promised, allow me to now introduce James Mulili to take us through his presentation. James, karibu sana.
Thank you, Jimmy. The previous session we had some time last year, and the conversation in our last session was basically on some proposed amendments in law, which were actualized on the 27th of December 2024. And like Jimmy has mentioned, some of these amendments might have caught some of us by surprise, because I believe on the 27th of December, you are most probably relaxing somewhere in a beach or in the park or in your rural area. So what we will basically do in this first session is to look at all those amendments that were effective from the 27th of December 2024. And what you will note in these amendments is that the bulk of these amendments were actually picked from the withdrawn Finance Bill 2024 after the Gen Z protests. Now, my colleague Kevin will actually touch on and give insights on what we expect to see in the 2025-2026 budget in terms of the budget estimates. But one thing you need to be aware, even as we go through these amendments that only came in around 3 months ago, is that you'll also note that by the end of this month, we should expect to receive the Finance Bill 2025. And I think the biggest concern among Kenyans has always been the constant erratic, unpredictable tax changes. And we are hoping that, as you will see from what we will go through, you will notice that there was a bit of cherry picking of some of the good proposals, particularly touching on employment income from the withdrawn Finance Bill 2024. And our hope is that we will not be looking at an adverse Finance Bill 2025. And we are hoping that the government will not use these amendments that came in December as a ploy to say, but hang on, we gave you good considerations from the withdrawn Finance Bill. So kindly bear with us. We still have to collect tax revenue. So that is really the expectation. So I just want to quickly go to the slides so that we can just have a quick overview of these amendments, some of which, and I believe a majority of these amendments have already been implemented in terms of tax compliance. So the very first issue is we'll touch on the Tax Laws Amendment Act. Basically, those amendments that either touch on the Income Tax Act, the VAT Act, or the Excise Duty Act. Then the second batch will be on tax procedural amendments. Now, as I mentioned, there was a cherry picking of the good proposals that were there in the withdrawn Finance Bill 2024, particularly touching on employed individuals. And as you are aware, before you are subjected to pay as you earn, there are those employment benefits that are actually not taxable. And a good example is pension contributions. Then you have the other set of employment benefits in the form of meals, the non-cash benefits, basically. And you see what happened in the amendments. There was actually an increase in the thresholds of some of the non-taxable employment benefits, which was a good reprieve. A good example is the threshold for non-cash benefits was increased basically from the annual amount of 36,000 shillings to 60,000 shillings. Then you had the meal benefit, basically where the employer is providing any meals to the employees. That meal benefit was also equally enhanced to basically from 4,000 shillings per employee as an untaxable meal benefit to 5,000 shillings per month per employee, which commutes to around 60,000 shillings per employee per annum. Then when it comes to pension contributions, remember the employee gets the first right of enjoying the non-taxable portion. Previously, that threshold was at a maximum of 20,000 shillings per month. That was bumped up to 30,000 shillings per month. Then when it comes to mortgage interest, I believe a majority of us could be servicing some form of mortgage, and that is what we call mortgage interest relief. That was also bumped up slightly. And you see the net effect of basically the increase in these thresholds, it sort of gives reprieves to employees in terms of the amounts of benefits that they can enjoy from employment. without being subjected to additional taxes by factoring in these employment benefits as part of their taxable income. Now, the conversation on affordable housing levy and social health insurance fund, what is popularly known as SHIF, and in some circles SHA, had a lot of negative effect on the take-home amounts for employees. And previously, what we used to have, we had, before the amendment on the 27th, we had reliefs that employees could actually enjoy. Now, what happened from the 27th of December is that the laws were amended to actually allow, remember, when in arriving at an employee's taxable pay, you will take the basic salary, you take all employment benefits that are within the threshold of being subjected to tax. Then you will deduct pension contributions, which include NSSF contributions. Now, in addition to the deductible contributions, basically affordable housing levy contributions by the employee are basically now deductible on the gross pay to arrive at the taxable income. Similarly, any SHIF contributions by the employee equally are an allowable deduction. For those of us who are making any contributions to post-retirement medical funds, those amounts are also equally deductible before arriving at the taxable income. But then for the post-retirement medical fund contributions, they are capped to a maximum of 15,000 shillings per month. So in effect, in summary, what am I saying? In terms of the reflection of the benefit of these deductions, I believe for those of us who receive a payslip at the end of the month, you must have seen, if not in the December 2024 payroll, at least from the January 2025 payroll, you must have seen a bump in an increase in your take home, because the affordable housing levy contributions, the 1.5% of gross salary, the employee's contribution, the 2.75% of the gross, basically contributed by the employee, and any post-retirement medical fund contributions were actually deducted before arriving at the taxable pay that is subject to pay as you earn. Then some very good proposal in terms of income tax exemptions when it comes to withdrawal of pension and retirement benefits. I think that, you see, is actually a good move, because then it means that upon retirement, any withdrawal of such pensions would result in a higher take home because of the exemptions that were extended. And actually, up to that point, I believe you can see that these amendments are actually very good amendments to try and cushion employees, especially after the introduction of SHIF and affordable housing levy. Like I mentioned, this seems to have been a cherry-picking exercise from the withdrawn finance bill to try and just cushion employees. Now, for non-resident persons who provide any form of digital services, and the scope for digital services is basically to the extent that if there is any service that is being provided over the internet, electronically, or through a digital marketplace, then that non-resident person is actually required to basically pay taxes in Kenya. And that was previously known as digital service tax, which was at the rate of 1.5% of the value of the service. Effective 27th December 2024, that has been replaced by what we call significant economic presence tax. And the effective rate really of significant economic presence tax is at the rate of 3% of the value of the service. So you can actually see the impact of significant economic presence tax sort of doubles what was previously the 1.5% under digital service tax. For multinational enterprises, it is important to note that there was an introduction of what is not referred to as minimum top-up tax at the rate of 15%, and the minimum top-up tax is in addition to the 30% corporate income tax that any multinational enterprise would be liable to in Kenya. And the way basically it works is, in as far as you're a multinational entity, there are certain checks that need to be confirmed before you know if minimum top-up tax is applicable to you. The first thing is, when we talk of multinational enterprises, you can imagine the big multinationals that are there. I don't want to mention any names in particular, but you will notice that one of the thresholds to check for the qualification of minimum top-up tax is that the consolidated annual group turnover is about 750 million euros. That in Kenya shillings terms is around roughly 95 billion shillings. So if you are a Kenyan entity that is part of a multinational group, then the very first thing you need to check if you've tripped up the minimum top-up tax is basically the annual consolidated turnover for the group. But then in addition to that, there is something that is also checked. So the Kenyan entity that is part of the multinational group is actually referred to as a covered person within the provisions of Section 18, which basically are transfer pricing provisions. And that Kenyan entity that is part of that multinational group that has tripped up the annual consolidated turnover threshold, if its combined effective tax rate is less than 15%, then the issue of the minimum top-up tax comes in to make sure that there is a cover for the shortfall in the effective rate of tax if it is below 15%. Then when we move on to the other one point, basically on family trusts, there used to be exemptions that were in place, but those exemptions for income tax were done away with effect from 27th December. If we move to the next slide, particularly on matters pertaining to the issue of royalties, royalty payments by a Kenyan person are normally subject to withholding tax at the rate of 5% if the royalty payments are being made to a Kenyan resident person, and a higher rate of 20% if they are being made to a non-resident person. But the non-resident rate could vary if there is a double tax avoidance agreement that gives a preferential rate of tax. Now, one of the biggest controversial issues has been for those people or for those Kenyan businesses that are involved in the distribution of software. So you find that this particular business imports software in the form of licenses, is also involved in the maintenance of this software, training, and any such support services relating to the software. KRA has been pushing and actually levying withholding tax on such companies that purchase software for distribution. There is actually a litigated case that confirmed that if you are not the ultimate exploiter or user of the right to that software, that does not constitute a royalty that is subject to withholding tax. And we believe that this amendment to include software development, training, annual maintenance, and support fees, basically as part of royalty, was informed by KRA losing that matter. But there is still a gray area, because if you read the definition of a royalty, it still starts by saying that it is basically a payment or consideration for the right to use. So in as much as they've gone ahead to list software, any payments towards the purchase of software as royalty, the question still remains, software distributors are actually not paying for the right to use, they're simply paying to procure the software for distribution. Then with regards to capital gains tax, there's actually a preferential capital gains tax rate of 5% on any transfer of investments that are under NIFCA. Basically, that is the financial center, and where basically the investment value amounts to around 3 billion within 2 years, and the transfer of those investments happen after a period of 5 years. So for those who are in that space, it is important to be aware that there is a preferential rate of CGT of 5% as opposed to the rate of 15%, which is applicable to any normal transactions involving transfer of assets. Then there is a reduced investment value that is eligible to investment deduction at the rate of 100%. You might recall up to 2022, we used to have investment deductions at the rate of 100%, and also accelerated investment deductions of 150% if those investments were outside Nairobi, Kisumu, and Mombasa. That was done away with in 2022. However, depending on the value of investment, you could still qualify for an investment deduction of 100%. An investment deduction basically means if you have incurred an investment to put up a manufacturing, basically a manufacturing plant, you've bought machinery used for manufacture, you've actually invested in substantially in hotels, then whatever cost you have incurred in your first year that you put to use your plant, your first year your hotel is operational, the full value of the investment was a tax deductible basically allowance. And that basically translated to a situation where the incentive was for those who have invested heavily in the manufacturing sector, in the hotel sector, were not paying any corporate income tax in the initial years of operation. So that's actually a very welcome incentive. However, in as much as the 100% investment deduction was repealed from 2022, it was still applicable to certain sectors where the investment was outside Nairobi and Mombasa, particularly on hotels and manufacture. The previous threshold prior to 27th December was investment value of 2 billion. That was reduced to 1 billion to make sure that at least it is more accessible to more businesses. For those enterprises that are under an export processing zone, basically an EPZ is one of the preferential tax regimes in Kenya, where you get to enjoy basically a 10-year tax holiday where you don't have any corporate income tax. After the 10-year tax holiday, the corporate income tax goes to 25%, which is still a lower rate. And it's actually a good incentive for those people or those businesses that face the export market. And it comes with a load of many other more incentives like customs duties, exemptions, RDL and IDF exemptions. So it's actually an opportunity for businesses that are facing the export market to actually explore. But then what used to happen in terms of any EPZ entity that fails to file its corporate income tax return, there was actually a very steep penalty of 2,000 shillings per day. The income tax return was unfiled. So the amendment basically from 27th of December was to align the non-filing penalty from the 2,000 shillings per day to 20,000 shillings per month, as is the ordinary case with other tax returns. Quickly, from a withholding tax point of view, basically there was introduction of withholding tax on payment or facilitation of payment on a digital marketplace at the rate of 5% for residents and 20% for non-residents. What you'll actually note is that over the past 3-4 years, there's been keen interest by the government to actually introduce taxes around the digital space, and this is obviously informed by the pace at which we're having digital transformation and basically a lot of businesses transitioning on the digital marketplace. Then I'd alluded to this point earlier in terms of income tax exemptions on payments and withdrawals from pension schemes after the expiry period of 20 years, and I think that was a welcome move. So there's similarly an exemption for withholding tax that was applicable on such withdrawals. For those of us who have an appetite to supply to government or public bodies or public entities, there was an introduction of withholding tax on the supply of goods at the rate of 0.5% for resident suppliers to public entities, and a rate of withholding tax of 5% to any non-resident person who supplies goods to a public entity. And basically public entity could be the government, any parastatals or any other government agencies. Then in terms of matters pertaining to anyone who supplies scrap, Just know scrap is anything that is considered to be waste and can be put to use to manufacture finished products. There is equally withholding tax that was that was introduced at the rate of 1.5% of the value of the scrap. If we move to the next slide, from a VAT perspective, the two major amendments was on the issue of claiming input VAT. Remember what previously used to happen before 27th December. If you are in business and what you are actually supplying, whether it's goods or services, basically falls under two categories. So you could either be having a mixed supply of taxable supplies. So when we say taxable supplies for VAT, we are talking of supplies or items that are subject to VAT at the rate of 16% or 0%. Then we have another, it's not really a category of VAT, but any item that is not subject to VAT at either the rate of 16% or 0% is considered to be a VAT exempt supply. And when it comes to accounting for VAT, basically VAT in a simplistic way works in an input versus output basis. And basically when we talk of output, we are saying if you are in business and you're supplying items that are subject to VAT at 16%, and your annual turnover happens to be more than 5 million, you're actually required to register for VAT and charge VAT at the rate of 16% for any local supplies, and account for VAT at the rate of 0% for any exports. Now, on the input side is where you are incurring any input on your purchases. And so ordinarily the way VAT would work is you have 16% output, you net that off against 16% input. If your output exceeds your input, then you have VAT to pay for that particular period. If your input exceeds your output, then the credit of the excess input is available to be utilized in the subsequent months against your output VAT. And so when it comes to the claimability of the input or the deductibility of the input against your output, the law provides that the first criteria is you use direct attribution. So if you've incurred input VAT that is directly attributable to making a taxable supply, you claim your input VAT in full against your taxable supply. If your input VAT is directly attributable to a VAT exempt supply, you are not supposed to claim your input VAT in totality. So then there is this other category of expenses that are called common expenses. And a good example, assume you are a business that is supplying both taxable and VAT exempt supplies, and you're paying something like rent for your office, for the go down. It is almost impossible to attribute that input VAT charged on the rental expense to either taxable or VAT exempt. So what used to happen, there used to be a formula where if your taxable supplies exceed 90% of your total sales in a month, you are not supposed to claim input on common expenses. If your taxable supplies exceed 90% of your total sales in that period, you can actually claim in full the input VAT that is attributable to the common expenses. So that 90-10% formula was done away with. So you simply can only claim deductible input on common expenses that you cannot directly attribute to taxable or VAT exempt based on the proportion of your taxable supplies in that particular month. A very welcome provision for group structuring and restructurings where there is transfer of business. Previously, those transactions would have to be subjected to VAT at the rate of 16%. At least an exemption was introduced. So if you're part of a group and you're forced to transfer business from one entity to another, basically that consideration will be considered to be a consideration that is exempt from VAT. If we move on to the next slide, from a Miscellaneous Fees and Levies Act perspective, there was an increase in the Railway Development Levy, Remember, railway development levy is applicable on all goods that are imported in Kenya, and that rate was increased from 1.5% to 2% of the customs value, and that is obviously expected to sort of increase the value of or the cost of imported items. From a tax procedures point of view, remember the Tax Procedures Act basically is the tax administrative act that will that governs all matters pertaining to tax registration, tax filing, tax payments, and any offenses that are committed for tax compliance. And a very welcome provision which Kevin will, my colleague, will touch on in his presentation is the extension of the tax amnesty. The tax amnesty is actually open until the 30th of June 2025, and the amnesty is basically waiving any penalties and interest for any unpaid principal taxes as at 31st December 2023. My colleague Kevin will expound on that. Then on matters pertaining to excise duty and VAT or refunds, basically any person who has a VAT or an excise duty refund application for overpaid tax, you have to make sure that that application is made within a period of 12 months from when it was overpaid. Previously for VAT, the timelines were you had 24 months within which to make the refund application. For those of us who have any disputes with the Revenue Authority, you have received a tax assessment and you're actually forced to either do a notice of objection or a notice of appeal to the Tax Appeals Tribunal. The timelines of the 30 days to either lodge an objection or lodge an appeal used to be 30 calendar days. The amendment is to the effect that the 30 days are only the working days. Basically, they exclude weekends and holidays just to give you more time to make sure that you do your filings in order. For those Kenyan employers who have remote employees, so when we talk of remote employees, you are a Kenyan employer here and you have someone in Uganda who is working for you remotely. There is actually a requirement now to make sure that that remote employee has a KRA PIN and his pay as you earn is paid in Kenya. And the simple reason is because that remote employee, in as much as they might not be a Kenyan tax resident, they are actually accruing and deriving their employment income from Kenya, and they are subject to tax in Kenya. Then remember, from 1st January 2024, any expenses that cannot be supported by an electronic tax invoice management system invoice are not deductible for income tax purposes. And I think the biggest debate on this particular issue has been for those businesses that deal with a lot with informal businesses that are not in a position to issue e-TIMS invoices, are not even tax registered. And there was a lot of debate. Should there be a threshold, maybe similar to the VAT threshold of 5 million shillings, to say if you are dealing with someone who is a small business with a turnover of less than 5 million, could there be an exemption? Now, unfortunately, even with the amendment on the 27th of December, there was no threshold set. The only thing that you need to be aware, the only expenses that are excluded from being supported by e-TIMS invoices, we have emoluments. Basically, these are salaries. You have interest payments. Then you have investment allowances. You have imports, as well as sort of any ticketing related expenses. Those are the only expenses that are exempt. The only additional exclusion from having to support basically with e-TIMS invoices was what was introduced, and it's basically any expense which is subject to withholding tax as final tax is also exempt from having to be supported by an e-TIMS invoice. But then the question is this: if you look at the only payments that are subject to withholding tax as final tax, you only have qualifying interest and qualifying dividends. So the question is that really a mute provision on basically exemptions to e-TIMS? Now, related to what I've just mentioned about the quagmire and the difficulty businesses faced with dealing with informal, basically suppliers from the informal sector, and those suppliers having to provide ITIMS invoices, it has now been, it was enacted into law that you as the purchaser from that small business or that informal business, you can actually reverse invoice. And this has actually been set up on eCitizen, whereas the supplier from this sort of small business or informal business that is not giving you an ITIMS invoice, you can actually go in, complete the necessary details pertaining to that particular small business or supplier, and you're able to generate an ITIMS invoice which you can use to support your expenses. So it is important to note that the challenge that was previously there in supporting expenses from these small or informal businesses, there is actually sort of a mechanism through which you can actually proceed and raise those ITIMS invoices as the purchaser on behalf of these small suppliers. Then some other amendments which are actually very critical, and it's largely one amendment. The issue of tax refunds in Kenya has been a challenge, but one of the very positive amendments from December was that if you have any form of tax overpayment, you can use it to utilize against other tax obligations. So if you have an income tax overpayment, you can use it to basically to offset against pay as you earn. You can use it to offset against VAT. And even more importantly, one of the welcome provisions, if, for example, you have an approved VAT refund, you can actually even use that VAT refund to basically offset your installment taxes. Remember, corporation tax is paid in the form of installments in the course of the year, whether on a preceding year basis or on a current year basis. So you can actually see, as I mentioned, and I think what has been sort of reverberating in my presentation is there was a cherry picking of the good proposals that were there in the withdrawn Finance Bill 2024. So that really brings me to the end of the first session, which was basically to just give a recap of all the amendments that were effective 27th December last year. And I hope we've been able to at least basically impart some knowledge. I'll stop at that and hand it over to Jimmy.
All right, thank you very much, James, and of course quite an insightful presentation there. So just a number of things that I think have come out for me, and we'll start where you've left it off. Number one, there's a 10% penalty for failing to comply with VAT withholding provisions. So that is something that I think most of us need to note, and also ensuring that your remote employees also have a KRA PIN to ensure that they can, that you're not caught up in a scenario where you are not compliant. So just make sure that if you have a remote worker, whether they're in the country or outside the country, they also have a KRA PIN, because again, like James said, they earn a living from Kenya. VAT refund claims time, also something notable here is the fact that this time has been reduced from 24 months to 12 months. And I think that is an important one to note, to make sure that you are within the legal timeframes that you will get your VAT refund. Something else that I think you should be able to note is the fact that Railway Development Levy has also gone up from 1% to about 2% of the value. And those are just some of the changes that happened on VAT. And I just want to go back to something that James talked about, which is income tax exemption on withdrawal of pension and retirement benefit, meaning that if you're about to retire, or if you're planning to retire in the course of the year and you want to get all your benefits, remember that there will be no charges on this. So income tax exemption is on that. And also just looking at affordable housing levy and SHIF, that is post retirements, and now allowable deduction. Quite some good news there. And also just looking at something that is not so good, and especially for those operating within the digital space, is the fact that significant economic presence tax was doubled. The proposal in the finance bill of last year was about 1.5% in terms of digital tax, but now significant economic presence tax went up to about 3%. These are some of the changes that came that were approved by the president around 27th of December last year. And of course, let me just remind you some of the value propositions that the bank has, particularly for prestige customers, which is the prestige protection. All right, so there's a free retrenchment cover on prestige bundle account when your salary is directed to your prestige account. This is one of the value proposition that Absa Bank has for you as a prestige customer. There's also a free gadget, home content, and forced ATM withdrawal insurance, and also education policies to secure your children's future. Those are some of the value propositions, and it is part of why we are having these conversations on financial wellness. And I will be giving you more details on that, on some of the other value propositions as we go on, particularly looking at prestige life and experiences, which includes things that are also fun, exposure to fun and fine things in life, just making sure that you live your best life as a prestige customer. Also access to Absa social events, and we're talking about whiskey tasting, wine tasting, movies, and other lifestyle experiences that you can be enjoying. Of course, that is only for you as a prestige customer. But besides the fun stuff, let's continue with the conversation. And I just want to welcome Kevin Chege now to do his presentation on what else customers need to be on the lookout for, and later on we'll be getting to the Q&A session. So remember, all those questions that you have regarding James' presentation and what Kevin is going to present, kindly just share with us on the comment section, and we'll be sampling some of them, making sure that all your concerns are addressed right here. Again, remember, these are the tax experts, so they have all the information. They can help you maneuver even as you plan for your financial futures. Kevin, over to you.
Thank you so much, Jimmy. And a very good thank you to James for a wonderful presentation on the tax changes that have already come into effect with the Tax Laws Amendment Act and the Tax Procedures Amendment Act 2024. Now, at this stage, I want us to look at the future outlook. What is going to happen? What do we need to be on the lookout for in the coming months in 2025? And what really would be the impact to us as customers for Absa and also on the general population? It's always good to be aware what is coming up. And moving on to that perspective is that at this time of the year, it's a very important period in the budget making cycle process. And taking the events of what happened last year, there's a lot of public scrutiny, there's a lot of public involvement, and actually that is what was envisioned under the provisions of the Article 220 of the Constitution, that the budget making process becomes a public participation process where the public is engaged, the public gets to provide their views. And based on what happened last year, we can see that the public views can really make an impact and a change for that matter. Just taking it back a bit is that the budget making cycle for 2025-2026 does not start with the CS just reading the budget. There is a series of events that happens before that, going back as far as 30th August 2024, when the commencement of the 2025-2026 budget making process started. And by 15th January 2025, the National Treasury released the draft budget policy statement and provided a deadline of 21st January 2025 as the deadline to submit proposals. So those proposals were given to the National Treasury, and at the beginning of this month, the National Treasury was able to publish and publicize the budget policy statement for 2025-2026, which is currently out and is easily accessible for the public to even continue scrutinizing and making their remarks on it. Now, the next 3 months become very crucial because I think that's where the much of the activity happens in terms of the budget making process, to the extent that in the next coming month, if there is a finance bill. I know it has been a question of will there be a finance bill 2025 or not, and it's a matter of wait and see. But if there would be a finance bill, the CS Treasury has a deadline of up to 30th April 2025 to have submitted the finance bill to the National Assembly for the first and the second reading, up to which there is public participation in terms of collecting views, and the public gets to submit their views on the same. And by 30th June 2025, the National Assembly should have approved the Finance Bill 2025 with or without any amendments, against which on 1st July 2025, the Finance Act of 2025, which will be assented into law by the President, will become effective. So it's a matter of wait and see if there will be a Finance Bill 2025, but I think going to what is on the budget policy statement for the financial year 2025-2026, I think there is all likelihood that we are going to get a Finance Bill 2025. Now, scrutinizing the budget policy statement for 2025-2026, I think what is coming out clearly is that the budget policy statement is anchored on what the government is calling fiscal consolidation, to ensure that the economy is not exposed to the vulnerabilities of public debt, as well as provide space for the government to provide essential goods and services to the public. And if you look at it from a macroeconomic perspective, the macroeconomic indicators so far seem to be stable and in favor of the government. We are talking about interest rates seems to have stabilized, exchange rate, inflation rate has sort of stabilized, and within the anchor rate provided by the CBK of plus or minus 5% for every month. But against that background, the economy still faces several shocks, both from an exogenous perspective and then from an internal perspective. From an internal perspective, there are huge shocks in terms of a huge unemployment level for the youth and the young population. We are talking about the high cost of living. We are talking about the ease of access to social amenities such as health is still a problem. And from an exogenous perspective, Kenya still remains vulnerable to global economic shocks and geopolitical shocks. I think the most notable ones, we can see what has happened in the last few months with the Trump administration making huge cuts on essential sectors like the USAID, which has had a very huge impact on essential sectors of our economy like the healthcare and so forth. So it is against that background that the government is creating the 25-26 budget, and it's a matter of looking forward to what the government will do in terms of trying to seal some of the gaps that have been left, maybe by the exogenous shocks that have been created sort of by the Trump administration. Now, going to the numbers, when you look at the budget policy statement 25-26, the budget size has increased not so much, but up to around 4.3 trillion from around 3.9 trillion last year. And that budget is being anchored on a development expenditure of around 800 billion, which is quite small. It's about 3.8% of GDP, which is not as per the recommendation of IMF, where we should be doing at least upwards of 10% of GDP. The current expenditure is still high at around 3.0 trillion, which is about 16% of our GDP, while the transfers to counties are at around 400 billion. Now, when you look at the budget 25-26, there is a projected additional revenue to be collected by the KRA We are talking about around 2.8 trillion to be collected by the KRA from a projection of 2.5 trillion the current year that ends in June 2025. And the significance of this is what we were talking earlier on. Would there be a finance bill? And ordinarily what happens is that the finance bill is supposed to come and provide the measures and the tax measures that are supposed to provide for the increased tax revenue for the year 25-26. So based on how the numbers look like, by all indications, we will get a finance bill in the coming month, which is supposed to provide the additional tax revenue measures that are aimed at collecting the additional tax revenue. And perusing through the budget policy statement, it's quite noticeable that in this year's budget policy statement, we don't have the specific tax amendment. A time like this last year, we had the specific tax amendments that were supposed to be introduced by the Finance Bill 2024, already anchored on the budget policy statement. Perhaps as an abundance of caution by the government, taking into consideration what happened last year, the government has been playing its cards close to its chest and ensuring that those specific tax revenue measures are not included in the budget policy statement. In terms of the fiscal deficit, which has to be funded through borrowing, we have seen it around 759 billion, which is supposed to be covered by domestic borrowing and foreign borrowing. So on the domestic front, I think the government is trying to get into the domestic market and borrow more instead of going to the foreign borrowing, sort of to try and cushion the economy from external shocks that are prevalent from an exogenous perspective. But again, on the domestic borrowing, I think the huge question has been when the government borrows so much from the economy or from the local market, does it lead to what we call crowding out effect, to the extent that the lenders are not lending to the general population and businesses and prefer lending to the government. Now, from tax revenue and tax and revenue measures, we are seeing the government trying to play it trying to play its card very, very close to its chest and trying to provide a broad overview of the tax and revenue measures that are supposed to be implemented in the budget 25-26. So we are talking about implementation of the national tax policy and the medium-term revenue strategy, which are supposed to provide sort of a predictable environment from a tax perspective. And it's something we want to see. Is the government going to abide by the provisions of the national tax policy, which provides that tax measures are not supposed to be changed gradually, but should provide taxpayers a period of time, at least 5 years, for any major changes to be made from a tax perspective. A conversation that has been ongoing for some time relates to the tax base expansion, which remains critical for the government in terms of ensuring that the tax basket is not being contributed to by just the employed and the businesses that pay taxes. There needs to be an inclusion of other sectors, especially the informal sector, into the tax paying bracket. There is also an issue of minimizing tax expenditure in the budget policy statement. This includes expenditures such as VAT refunds, which have been delaying for some time, and the government is trying to minimize that expenditure. Maybe we are going to see a scenario where goods and services that are subject to zero rating from a VAT perspective being reduced. Another important aspect that has been highlighted is leveraging on technology and ensuring that all revenue loopholes are sealed to ensure that maximum collection of tax revenues, and enhancing efficiency of the tax system to ensure that the government is able to collect more from in terms of tax revenues. There is also a focus on what we call non-tax revenue from government, ministries, departments, and agencies as a source of revenue to the government to try and cushion the gap that had been left sort of by by the finance, by the collapse of Finance Bill 2024, and also try to create a room for additional collection, not going the tax perspective. So here we are talking about various services that are offered by the government. We might see a certain increase in the cost of the government services, and that has been happening over time. We are talking about what had been proposed, maybe to increase the cost of accessing things like passports, things like birth certificates, and so forth. It has become an area the government is really looking forward to try and raise additional revenues from that area. Moving on to another area is that for a very long time, we've always talked about the revenue mobilization perspective, simply talking about tax measures to increase the revenue collection by the government. And I think it's a high time that the government takes a look at not only the revenue perspective, but also the expenditure perspective. And if you look at the budget policy statement 25-26, it talks about two aspects that are aimed at fiscal consolidation. The first aspect is on revenue mobilization, and the second aspect is on expenditure rationalization. So on the expenditure rationalization, it's quite obvious that there has been a lot of wastage in the government, and it's a high time that the government puts in measures to curb the wastage. And if that wastage is reduced, I think we might get it to a point where the government does not even need to put so many punitive taxes to try and collect more. We can work within the space where the government is able to collect enough, and that money is put into good use. So from an expenditure reforms that are proposed in the budget policy statement 25-26 includes the implementation of what we call a treasury single account, where the treasury is able to have access of all banks' records and statements and accounts that are owned by the government and government agencies, departments, and agencies. I think this is borrowing from what has happened with the eCitizen platform, where the government has centralized all payments to a single eCitizen platform. I think that is also going to happen from government banks' accounts. There is also the proposed transition from cash accounting by the government to accrual accounting to ensure that at the very least, the government is able to account for its assets and liabilities on time, as compared to the current scenario where the government operates on a cash basis. There is also the proposed adoption of a zero-based budgeting approach, as compared to the current budgeting approach where the government works on what was spending from the previous year and then it's budgeted in the current year. So under the zero-based budgeting approach, you start by budgeting for all expenses and accounting for all expenses, and you start from a zero base instead of starting from a base that was carried forward from the prior year. There is also issues to do with public investment management reforms as well as national assets. So we are talking about there is space for the government to ensure that from an expenditure perspective, there is rationalization to curb on the wastage, and in effect that may also offer a room for the government to be able to put the money that is able to collect from the taxes into good use without coming back to the population by implementing some of the punitive taxes measures that had been proposed in the prior year. Moving on to another notable change, and that we are on the lookout for in 2025-2026 relates to NSSF contributions. I think this has got the public attention, possibly in the last 2 years, where with the implementation of the NSSF Act 2023 from 2021, there has been a gradual increase of the NSSF contribution, and as of February this year, which is last month, the year 3 contributions peaked in, which are at the rate of 2 times the national average wage earnings, which I'm sure most of us who are in employment have already felt the impact of this, the gradual increase in the NSSF rate. And the reason why this becomes an important aspect or item to be on the lookout for is that we are not yet off the hook, because whereas the year 3 contributions took effect in February 2025, we are anticipating and hope to see that year 4 contributions will also peak in February 2026, which now will be at the rate of 3 times the national average earnings. So until 2027, we are bound to see a gradual increase in the NSSF contributions come February of every year. So I think that's something we need to be aware of and on the lookout for, that as much as we got an increase in the NSSF contributions in year 3 this year, we are also looking at year 4 contributions picking up in the next February 2026. So in a nutshell, I think to summarize the key events to be on the lookout for in 2025, we are talking about Finance Bill 2025, which by all indications will have to come out in the month of April. SPKF are on standby to provide a detailed review and analysis of the Finance Bill 2025, and we'll be sharing the details of when that comes out. We are talking about NSSF year 3, year 4 contributions, which are supposed to peak in 25, February 25, February 26, and February 27. Something else that is coming out and has become a matter of concern, not many of us ever thought the impact this would have to a country like Kenya, is the impact of Trump's protective measures on the economy, on the US economy, as well as on the multinational enterprises. On this perspective, we have already seen what has happened from a USAID perspective. I think the greatest impact has been on the health sector. The government needs to be on the lookout and maybe go back to the drawing board, because in the budget, when the budget policy statement was being made, it factored some of these amounts that come from the USAID to cover the health sector. Now that has been seized. We are talking about a figure of around 108 billion shillings from the USAID that was coming into the country. That has ceased to come, so it's up to the government to try and look for other measures to raise that. James talked earlier on about the significant economic presence tax, the minimum top-up tax, which, just to take us back, were an initiative of Joe Biden and the OECD. And if you look at Trump's executive orders, I think the first executive orders he signed was to the effect that no country has the right to tax US multinational enterprises, and if any country goes ahead to tax US multinational enterprises, Trump has threatened to effect tariffs and other measures on those countries. And we have already seen what is happening with that threat. Trump has already effected tariffs and quotas on his immediate neighbors, Canada and Mexico. So you see, the significant economic presence tax and the minimum top-up tax were primarily supposed to tax most of those multinational enterprises, many of them who are domiciled in the US but carrying on business in Kenya, and they are generating income from Kenya. And it's a matter of wait and see and what the impact of that would be. Will there be a revision of those tax measures, maybe to avoid any tariff and quotas being imposed by the Trump administration on the country? It's just a matter of wait and see. We also on the lookout for any tax reforms to be introduced by the KRA in terms of through the Finance Bill 2025, as well as any other measures that may be introduced that have an impact on the taxpayers. We are looking at notable litigations, one of them being the Affordable Housing Levy matter, which is still at the courts. We are waiting to see what the verdict of that would be. Another item to be on the lookout for is the tax amnesty program. We are in the last 3 months of the tax amnesty program, and the tax amnesty program works out in a way that if you have any principal taxes for the period up to December 2023, and you've not paid those taxes, or you have any litigation matters with the KRA that have a contingent tax liability, it's a high time as taxpayers and as we are able to take advantage of the amnesty to the extent that if you pay the tax, the principal tax by 30th of June 2025, or you make arrangements to have settled the principal tax by 30th June 2025, you will qualify for 100% waiver of the penalties and the interest that come inherent with that tax liability. Something also notable to note around that tax amnesty program is that effective 1st July 2025, if you have any tax arrears, any principal taxes, and they have accrued any penalties and interest, you will no longer qualify for any waiver of the tax of the penalty and the interest. So the full amount of the principal tax, the penalty and the interest will become a payable debt by yourself to the government. So it's a high time we take advantage of that in the home stretch period of that, the last 3 months. So if you have any tax arrears, you can take advantage of that and settle the same. Another notable item that has come up maybe towards the end of last year has become a significant event in the first half of this year is issues to do with migrated legacy balances. The Kenya Revenue Authority issued many taxpayers with letters showing that they have migrated legacy balances. So in the legacy system was the system prior to the current iTax system. So if you had any credits, any tax arrears from that period, the Kenya Revenue Authority wrote to taxpayers telling them to provide records and reconciliations to show that their legacy statements are up to date. And if there are any credits that need to be migrated to the iTax system, they need to be migrated as soon as possible. I think taking note of the tax amnesty program that is currently ongoing, it's important that any person who has issues to do with the migrated legacy balances, you're able to offset them or reconcile those before end of June, so that if there are any penalties and interest that will accrue out of the principal taxes that come out of it, you're able to enjoy a waiver of the penalties and the interest. I think at a nutshell, that wraps up the key events to look out in 2025. As I said earlier on, we are in the a very crucial 3 months in terms of the budget making cycle process, and which based on the events that have happened prior in the last year, the public is quite aware of what is happening. The public is engaged, and it's quite notable that the public continues being engaged as provided for under Article 220 of the Constitution, because this is what was envisioned, and it provides a good outlook from the public, that people are aware of what is happening and their voices can be put forth and heard by the government. At this point, I would hand it back to Jimmy for the questions that have come in the session. Back to Jimmy.
All right, thank you very much, Kevin. So a number of things that actually have come out, and of course for me, they almost confused you with Treasury PS, because the things that you are talking about are largely from monetary policy area, and of course these are numbers these are provisional numbers that we've been hearing, of course, from the National Treasury and also from experts such as Kevin and James here. So a couple of dates that we need to be on the lookout for. Date number 1, this is 30th of April. By then, the finance bill should have been submitted by Parliament. Date number 2 is 30th of June. The finance bill must have been either approved or amended by Parliament before its ascension. Now, on July 1st, if the finance bill comes and it goes through all the stages and is approved, it effectively becomes the new law going forward into the next financial year. Those are the 3 key dates that we really have to remember that. Now, a number of things that Kevin, you've talked about. One of them is macro stability. And of course, I'm sure for a lot of us who are in business, this is something that we have noticed when you look at interest rates, when you look at even what the central bank has been doing in terms of just trying to bring the rates down. This is something that we have noticed when you look at numbers, the inflation numbers. We've been seeing that sort of stabilize over the last couple of months. That is from mid last year, that has come down. Also, in terms of areas of of vulnerability. Number one is just looking at the provisions in the budget policy statement in terms of government expenditure. We expect that in the next financial year, if the BPS is anything to go by, the allocation for development is slightly lower than what is currently allocated to recurrent expenditure, and of course that is quite an area of concern. And also looking at about 804 billion shillings that has been allocated to development. Yet something else that we are seeing this year, that we have seen over the last couple of years, is the fact that in yet another financial year, we have a progressive budget, 4.3 trillion shillings budget. That is up from 3.9 trillion budget that we saw last year. And of course, that has, because of the several supplementary budgets that have been brought in, that has slightly gone to about 4 trillion budget. And of course, we're talking about a deficit of 759 billion shillings, which will be funded both by domestic borrowing and external borrowing. And of course, with the more domestic borrowing that we have, that will have an impact in terms of your ability to access credit from the local market, from the domestic market. And also another trend that we have seen within the financial sector is that most financial institutions, particularly when you look at data from the Central Bank and the Kenya Bankers Association, they're saying that up to 40% of their net interest income is coming from credit to the government. That is no small. That is nearly 50% of their entire loan book portfolio, and of course that is an area for concern. Also, something else that we need to remember is the NSSF deduction. Now, we've not seen the last of it yet, and of course, for those of us who are still on salary, we saw the changes that had on your February salary, and this is likely to continue going into 2026 all the way to 2027. Now, gentlemen, we've gone into my favorite part, which is having now this conversation and just getting the feedback that we are receiving from our audience. And one of the things that I want to start with you, Kevin, when you see the expenditure priorities, something that, of course, a lot of those of our audience that are in the business segment or are currently service providers, either for government, is the issue of pending bills. This is still a major pain point for a lot of people in business. How do you see that panning out in 2025-26 financial year?
Thank you, Jimmy, for that. Yeah, it's the pending bills has been a huge issue to many suppliers to the government. We have seen in the last 1 year the government even going ahead to create a task force to try and verify those pending bills. So as a matter of priority and in terms of the expenditure for the government, we expect to see allocation in the budget to cover, although not all, at least a substantial amount of those pending bills. Remember, those pending bills have a ripple effect on the economy. They offer items to do with circulation of money in the economy. They ensure that so many of those suppliers don't get into debt and insolvency issues because they have money locked with the government. And it also creates a circulation of circulation in the country in terms of money and creation of jobs. So I think this is one area we expect the government to try and push forth in the coming budget, to create at least a substantial amount of it coming from the exercise that has been carried out in terms of the verification. We expect that what has been verified at least needs to start being offset in terms of by allocations by the government.
James, I just want to bring you into this conversation, and something that I would really want you to help us understand. We've talked about the tax amendment bills, the Tax Amendment Act of 2024 that came into effect on December 27th. And we've also talked about the Tax Procedures Act. And for someone who maybe is listening in part of our audience that does not understand what is the difference between the Tax Amendment Act and the Tax Procedures Act, could you help us also understand what do you think the government is trying to do with some of them, the proposals in those two amendments?
Yeah, thank you, Jimmy. So in essence, what normally happens is besides the finance bills and the finance acts that are always the primary sort of legislation that is relied on every financial year, what normally happens is that you find, for example, after the Finance Act is enacted and assented on the 30th of June, the laws cannot be amended in a duration of time that is less than six months. But then what now normally happens in a financial year, if the 6 months lapse and the government sees the need to actually amend certain laws, obviously after subjecting it to public participation, because I think that issue of public participation became very critical with the Finance Act 2023, as well as the withdrawal of the Finance Bill 2024, the government can actually make an amendment in law through what we call the Tax Laws Amendment Acts. So that's basically the genesis of the Tax Laws Amendment Act and Tax Procedures Amendment Act. If you might recall, in 2020, around 25th of April 2020, during COVID, the former president, Uhuru Kenyatta, and the government and the administration then enacted the Tax Laws Amendment Act of 2020. And it was during that time that there was a reduction in the VAT rate from 16% to 14%. There was the reduction of the corporate income tax rate to 25%. So the very essence of the Tax Laws Amendment Act, for that intervening period after the 6 months, for the government to be in a position to make any changes to the law. Another act that is normally relied on, I think, is the Statutory Instruments Act. So it's actually one of the other pieces of legislation that is relied on to make any tax changes as and when they become necessary and within the legal framework.
All right, so James, I just want to take a couple of questions from our audience in regards to your presentation. We have Vincent, who's asking, do we consider a company registered in Kenya and doing business outside Kenya, thus engaging employees in foreign country, quote unquote, non-Kenyan, or to have employees obtain a KRA PIN and deduct pay? That is one of the questions that is coming from Vincent. And we also have another question that is coming from Xavier, who's asking, how do I make my returns after having lost my job last year, but now doing consultative part-time jobs for NGOs?
Okay, thanks Jimmy, for that question. So maybe to address the first question, I think if I got it right, you have a Kenyan registered company that is partly doing business in Kenya and partly doing business outside.
Yeah.
So first of all, for the Kenyan company, Section 4 of the Income Tax Act is very clear that for any registered Kenyan company that is partly doing business in Kenya and partly doing business outside, the total income generated by that Kenyan company, both in Kenya and outside, is considered to be income that is accrued in or derived from Kenya, and all that should be declared and taxed in Kenya. And a typical example of that case is where you have a Kenyan company that has a branch office, or what we normally call, in simple terms, a permanent establishment in another jurisdiction. And basically, a permanent establishment simply means a fixed place of business in that other country. But by virtue of being Kenyan, being registered in Kenya, what ordinarily happens is that the total revenues for that particular Kenyan company will be deemed to have accrued in or derived from Kenya. So that does not cause a deviation on the issue of the remote employees, because the remote employees still remain primarily employees of the Kenyan employer, that despite having revenues from Kenya and outside Kenya, is still deemed to have accrued all that revenue in Kenya. So that requirement for remote employees to have a PIN still persists. Then I think it was that issue of that employee who's left employment. How do they complete their returns in light of the fact that they could be providing consultancy services to NGOs? So ordinarily what normally happens is, remember, for a particular year of income, the period that you are under employment, the pay as you earn, or the employment taxes, remember, assuming your employer is compliant, were already remitted to KRA by the employer on your behalf. Mm-hmm. So what you will notice, even if, say, for example, it's the 2024 year of income, and that particular employee left employment in June 2024, at the point of filing the 2024 return by the 30th of June, there will be two components that particular individual will have to declare. The first component will be the component that is attributable to the employment income earned for the 6 months. And that one is normally an easy return to complete, because if you are only earning employment income, there's actually a simplified way to file the return, because then it automatically picks the credits for pay as you earn, and the return becomes simple. Now, the issue of sort of having the remainder of the year, so I'm assuming this person was in consultancy from July 2024, and the basically the NGO that they're providing the services to withheld tax by virtue of basically receiving consultancy or professional services. What that a particular employee will be required to do, they'll have to download the return and populate it afresh, populate it with the details of the employer, the pay as you earn that was paid, which should match the credits in the system. But then over and above that, they have to declare the gross up income attributable to the withholding tax that were deducted. Now, and you see what will happen for this employee working on a consultancy basis, there's still the opportunity to claim expenses. So if they just declare the grossed up income, remember the withholding tax that was deducted at source by the NGO they were providing the services to is not final tax. At the end of the day, whatever grossed up income they declare will still be subject to corporate tax, at least at the rate of 30%. So what they need to factor in their returns is that if they have any expenses that they incurred in the course of providing the consultancy services, they claim those. But then also goes back to the point that we mentioned, it is advisable that all those expenses are supported by eTIM's invoices for them to be allowable. So that is how that particular employee will go about completing the income tax return.
All right. And Kevin, I want to bring you back into this conversation. And there's a question around, so Treasury is talking about accrual accounting. At the same time, they're talking about Treasury single account. At the same time, they're still talking about adopting a zero-based budgeting. And I just want to know, for our audience who are suppliers in government, how are these changes going to affect them?
Okay, thank you, Jimmy. Now, all those measures, if you look at them, they are aimed at expenditure rationalization by the government. And as part of the expenditure rationalization, the first effect will obviously be the government will try to cut any unwanted, unwarranted expenditure. But that's the issue we are talking about, zero-based budgeting. We are saying that the government will have to account and justify all expenditures that are being incurred in a particular year. In terms of the accrual accounting, it comes as a reprieve to many of the suppliers to the government, because we are saying going forward, government, like any other businesses, will now need to account for its assets and liabilities. And by accounting for its liabilities simply means that at the beginning of every year, the government will recognize how much it owes maybe the suppliers, and that one should become a priority in terms of if any money is available for offsetting that. So I would say it's a double-edged sword for many suppliers to the government. To one extent, any unwanted, any unwarranted, any excessive expenditure will have to be trimmed through the implementation of those expenditure rationalization measures. But at the same time, it also offers a reprieve to many suppliers to the government, but that at any one time the government will be recognizing that these are the liabilities, and if any amounts are available for offset, they should prioritize on offsetting those liabilities that the government has already recognized. We have seen in many instances, maybe currently, that there is no rational formula on how the government offsets its bills, its liabilities, and it has provided a lot of issues to many suppliers to the government. Coming back to the issue we highlighted earlier on the pending bills, that is something that has maybe sort of brought up a build-up of those pending bills. So with those expenditure rationalization measures, we also expect that issues to do with the pending bills by the government will gradually reduce over the coming years.
All right, and James, again, let's go back to the issue around VAT refunds. And I know VAT refunds are almost in the same category as pending bills. It's always a headache to try and get them. Now, there've been a couple of changes in that, and one of the notable changes on VAT refunds is the fact that the time to claim has been reduced from 2 years to about 12 months. And I want to know, when I'm planning for my business going forward, what are some of the things that I need to do to make sure that I take advantage of these 12 months and get my VAT refund on time? Or what are the other options to try and take advantage and maybe net, or do I just net it off?
Yeah, thank you, Jimmy, for that question. I think one of the biggest challenges, especially for exporters, and when I say exporters, the reason is because they're dealing with a category of supplies, and when I say supplies, I'm basically saying what they supply in the ordinary course of business that is subject to VAT at the rate of 16%. But at the end of the day, remember, these guys are incurring all manner of input, VAT, and basically input VAT is the VAT on purchases. So remember, the simple way of the way VAT works is output, input. So you find that, for example, for the exporters, they are perpetually in having excess input VAT that they can never utilize against any output, because the output anyway is subject to VAT at the rate of 16%. So basically the accumulation of the VAT refunds is for this category of businesses. The only other instance you could also have an accumulation of excess input VAT resulting in a VAT refund is because of any excess input credits because of withholding VAT. And the law is actually very prescriptive as to who would actually be in a VAT refund position. So it's really more of a closed space in terms of who qualifies for the refunds. And obviously, as a business, from a cash flow point of view, you would want to leverage on the refunds, hence the need to make sure that there is vigilance, there is proper accounting, there is proper documentation to actually show that you exported, because that's one of the checks KRA does when they're auditing any refund application. So it's pretty much of a very locked space with regards to VAT refunds. However, the issue of the VAT backlog is a long-standing issue, and I think each of the administrations in each budget has always raised the challenges around the VAT refund backlogs. And I'll go to something that Kevin alluded. And when the VAT Act was enacted in September 2013, the original intention, after repealing Cap 476, which was the previous VAT Act prior to September 2013, the government's intention was to actually do away with a lot of tax leakage that comes in the form of VAT exemptions and VAT zero rating. If you look at the medium-term policy statement, actually one of the recommendations was to almost not have any schedules in the VAT Act. And when I say schedules in the VAT Act, I'm basically referring to the first schedule and the second schedule, where the first schedule lists all goods and services that are VAT exempt. Second schedule lists all goods and services that are zero rated. And the practical way to sort of seal the loophole on this issue of VAT refund backlogs is to avoid an accumulation of more refunds, which happens on a daily basis. You'll have this exporter filing a refund this month. They've made the application next month, there's still an accumulation of refunds. And the main challenge is always the availability of funds allocated towards refunds. And just to give a case in point, so that you know this is actually quite a very critical issue. There's a particular client we deal with. The accumulated refunds are almost 2 billion. Now, if you look at the rate at which the government pays out the refunds, it's very slow rate. You find that it's almost an allocation of a maximum of 30 million shillings per refund cycle. Now imagine how long will it take for this particular client to actually recover the refund. So it makes no sense. And that's why the offset provisions were introduced. But the long-term solution to these refunds is a situation that we foresee where a lot of these exemptions and zero ratings will be done away with, and almost literally everything will be subject to VAT at 16%. And you see what that in essence will do. It will actually reduce the amount of accumulation of VAT refunds. So that seems to be the long-term situation. Given the current provisions, it is clear who qualifies. So if there is no money available to pay the refunds, there will always be a perpetual VAT refund backlog issue.
So for anyone who's running a business, James, the question is, what do I need to do to make sure that I try and minimize my VAT headache, my VAT refund headache? Already, let's say, assuming I'm already owed by KRA, okay? What do I need to do to minimize that headache and just not have it in my books, or I don't have to keep waiting for KRA to refund me?
What I would say actually, it's very difficult to say to minimize the headache, because you see, if you have a refund, you have a refund. Now, what I think they tried to do in terms of trying to expedite the process by KRA is to introduce timelines. What never used to be there prior to July 2023 were timelines within which the commissioner is mandated to make sure that they revert either with an approval or a rejection of the refund. The commissioner now has 90 days. If you make a refund application and within 90 days the commissioner does not communicate that they've either approved or rejected your refund, the law expressly provides that the refund is approved. Now, does the KRA follow that? Not many times, but it was like the legal cushion to just assist taxpayers in making sure that there is an expeditious processing of the claims. So obviously, for a taxpayer who does not receive any communication within the 90 days, it is actually within your legal right to demand for the refund, because the law is clear in terms of locking in the timelines. But besides that, like I said, it's pretty much of a very static situation, because in the ordinary course of your business, if you have zero-rated supplies, you will always, depending on the nature of your business, you will always incur input. You cannot let that input go, because then it means that becomes a cost to your business. So the only reprieve you have is to apply for a refund, at least to get the money, to get that money back in the form of cash.
All right, so exactly 90 days, and you must have gotten a response from KRA. Now, James, in your presentation, one of the things that you talked about is the Trump effect and the effect of Trumponomics. I just want to know, have we seen the worst of it yet, or do we expect more shocks going deep into the Trump second term?
Jimmy, I think that's for me. Yeah, sure. Yeah, I think this is one of what we are calling the exogenous shocks that the country is exposed to. Something we were not even anticipating until January 20th, when Trump took power. The effect of it is still being felt. And to your question, are we yet to see the worst of it? I think we are yet to see what the full impact of it will be in so many sectors of the economy. The most hit at the moment will be the healthcare sector. And also, looking at it from a bigger perspective, we are seeing that around 108 billion shillings used to come in through the USAID. Of course, the other US government agencies that were benefiting from the budget by the US, which have been cut by the protective measures that have been introduced by Trump. The ripple effect of that on the economy will be huge. So we are yet to see the worst of it, because we are talking about, these are people who used to earn good salaries working for those US government agencies. That money is no longer now in circulation in the economy. Talking about cuts in terms of maybe the places these people used to spend that money on. So the ripple effect of those protective measures that have been introduced by Trump is yet to be seen. I think in the course of time, we are going to start feeling the effect of it. And also maybe to extend it to the point that We talked about the notable tax changes that affect also US multinational enterprises that are operating in Kenya, and to which the Trump Executive Order number 1 has provided that no foreign country has the right to tax US multinationals, principally reversing what had been introduced by Joe Biden through the minimum tax reforms of the 15% of multinational enterprises. That will have a huge effect in terms of even those multinationals, and that amount that had been targeted by the Kenya Revenue Authority to be collected through the significant economic presence tax and the minimum top-up tax. So I think in the course of time, we are going to see the full effect of what those changes by the Trump administration will have on the country.
All right, so Kevin, while you still have the mic, there's a question here from Joseph who's asking, what will happen to NSSF contributions after 5 years? Will it continue increasing?
Well, I read through the NSSF Act of 2013 provides that they will gradually increase up to the 5th year. So we expect the rate to stabilize in year 5, which is the year 2027. I just want to throw a spanner in the works and say that will that be the full effect? No, because back to the NSSF Act of 2013, it provides that the minimum average wage rate should be the average wage rate published by the Kenya National Bureau of Statistics for the prior year. Now, the 36,000 shillings base we are using currently is the rate that was published in 2012. Now, I think what might happen going forward into the future is that if we are going to base the minimum average wage rate based on the most recent published data by the Kenya National Bureau of Statistics, I think a look at that, the last year one was around 58,000 shillings, then more likely than not, the rates will not stabilize in year 5. There will be also a gradual increase. But based on how the circumstances have happened, that minimum average wage rate has not been altered. We are still using 36,000, which is 2012. But if it is rationalized to the most recent one, then that would result in another increase in the NSSF rate. I am sorry to be the bearer of the bad news, but it's what it is. Yeah.
All right, thanks so much, Kevin. And of course, for those who are following this conversation, just a quick reminder that the entire conversation will be posted on the Absa Bank YouTube page. That is, you should be on the lookout by Tuesday next week. It should be ready and uploaded. And if you want to go back to the initial conversation that we had sometime last year, you can also go back and watch it. It's already on the website, and I can confirm this because I was watching it in the morning. So if you feel there are some elements of it that you missed, part of this conversation that you need clarity on, maybe you can just go back and watch and watch that. And just to continue with the questions, James, we have another question that is coming in from a fellow James who's asking, where a Kenyan company is subjected to tax with respect to foreign income, the entity abroad subjection to tax, does the tax charged abroad qualify for double taxation? That is one part of that question. The other question is, in our previous example, where a Kenyan company has a branch in another country and all the income from the foreign branch is subjected to tax, if the branch pays the tax in the foreign country, will the Kenyan company deduct that foreign tax paid in local Kenyan country? A bit of a mix up there, but...
Yeah, so the first question, I don't know if I got it clearly, but I believe the question was, it's a Kenyan company that is receiving some income that has already been subjected to foreign tax. And I think the question there then is the Kenyan company still required to pay, required to pay taxes in Kenya on the same income that has been taxed in the other jurisdiction? I believe that's the question.
Yes.
So I think I'll answer based on my understanding. So what normally happens is, remember when I was making the presentation, and if you look at the charging section in the Income Tax Act, it basically talks of any income from business that is accrued in or derived from Kenya. So that is the basic concept. Now, what does that mean in terms of being accrued or derived from Kenya? There are two instances where a Kenyan person is taxed on their worldwide income in Kenya. And when I say worldwide income, is that Kenyan person is being taxed on the income that they have accrued or derived from Kenya, and also from any income that they've accrued or derived from outside Kenya. The first instance is employment income. If you are an employee working for a Kenyan employer, and this happens a lot with expatriates, where you have a Kenyan employee working for a Kenyan employer, they are partly paid in Kenya, then they have a split contract sitting, say, with the parent company or with the head office somewhere in Europe. By virtue of being in employment, and that individual being a Kenyan tax resident, they are taxed on their worldwide employment income. So that what basically means is that Kenyan individual who's a Kenyan tax resident, and it's important to note there's actually a difference between citizenship and Kenyan tax residency. You can be a non-Kenyan citizen, but you're considered a Kenyan tax resident. And tax residency is basically triggered by the first condition is you have been in Kenya for any duration of time, and you have a permanent home. And a permanent home is basically defined not only to include your habitual abode, but the place or the jurisdiction where you have your closest economic interests. So like where you've invested a lot. Or if you don't have a permanent home, you've been in Kenya for more than 183 days in that year of income, or you've been in Kenya in that year of income and in the 2 preceding years of income for an average of 122 days. So you become a Kenyan tax resident as an individual. So for an individual who's a Kenyan tax resident, they will be taxed on their worldwide income. Now the issue of double taxation for an individual comes in because if you're telling me I'm being paid in Kenya and for example, I'm being paid in the UK, I'm supposed to combine the two incomes, subject them to tax in Kenya. Then the question is, if I've been taxed in the UK, how do I get the reprieve of the tax? Am I being double taxed? Now, that's where the purpose of the double tax avoidance agreements come in, because they would allow such an individual, but only in instances where Kenya has a double tax treaty with the other state. The issue of double taxation could become persistent in an instance where you have this Kenyan tax resident paid in Kenya, paid in another jurisdiction that doesn't have a double tax treaty with Kenya. That individual might end up being double taxed. Now, just to put it into focus, our Income Tax Act is very particular. If you are a Kenyan citizen, now by default, Kenyan citizens are assumed to have permanent homes in Kenya. So Kenyan citizens are considered to be Kenyan tax residents. Kenyan citizens are cushioned from double taxation by being allowed to actually claim any credit for any employment income that has been taxed in another jurisdiction. Kenyan citizens are cushioned to that effect. Non-Kenyan citizens might suffer double taxation if the jurisdiction they're earning the other part of their income is a jurisdiction that doesn't have a double tax treaty with Kenya. So I think that is on individuals. Now, the other category of income earned by a Kenyan person that is subject to worldwide income is the example of a Kenyan registered company with a permanent establishment in another jurisdiction. And I think one of the typical permanent establishments is normally what we refer to as a branch office. A branch office and the head office are one and the same. A branch office is normally simply an extension of the head office. And that's why, in as much as that branch, say you have a branch in Uganda, will still be taxed according to the Ugandan laws. From a Kenyan side, that income earned in Uganda will, and expenses as well, will still be consolidated on the Kenyan side, and it is actually the Kenyan entities looked, including its branch, are looked at as one and the same. So in that Kenyan registered company Ugandan branch scenario, in terms of the consolidation of the business income that is subject to tax in Kenya, it still factors in those expenses that have been incurred by the branch. So net, you'll still be looking at the overall performance of the Kenyan company itself and the branch as a combined unit. So it might not result so much in double taxation. But then there is also the issue of any withholding taxes that have been deducted in foreign jurisdictions. Those ones are claimable if you have a treaty in place. It is actually quite unfortunate for Kenyan multinationals. And when I say Kenyan multinationals, these are Kenyan entities registered in Kenya, eventually moved into the region in East African Community, for example. So there's a subsidiary in Uganda. The Kenyan entity is earning some management fees from Uganda. The Ugandan entity has to deduct withholding tax at the rate of 15%. It is unfortunate that we don't have a double tax treaty in the EAC that is in force. That withholding tax deducted ends up being a cost. It's actually tax that cannot be claimed by the Kenyan entity. So there are those nitty-gritties that come in terms of being able to fully utilize foreign tax credits. And I believe that answers the two questions.
All right, sir. Thank you very much, James. And just to remind our listeners, in case you're looking for an investment opportunity, we have the Absa Bank Money Market Fund, which is a viable investment and of course giving very good returns, and also government bonds through Absa Bank, which you can also reach out to your relationship manager, and of course they will be able to guide you in terms of how you can get started for those who are looking for places to invest. And something that we were told earlier on about, which is the affordable housing mortgage at only 9.5%, which is up to 10 million shillings. And of course, this gives you about 25 years, up to 25 years to repay, and 110% loan to value. So of course, some very good insights there that you can also take advantage of. This is, again, we said the aim of these webinars is to make sure that we give you prestige wellness. We're not just talking about financial wellness, but we're talking about prestige wellness. These are tailored products specifically for you, our prestige customers. Now, Kevin, there's a number of things that I want you to help us understand, and I see our time is far to spend, and there's a question around surprises. Now, in the last finance bill, one of the things that we saw is it led to street protest. It led to the entire finance bill being the president not ascending to it, and of course the government being forced to come up with other ways of raising revenue. Now, when you look at this year's budget, we're looking at collecting about 340 billion shillings more in revenue. And I want to know, where is this revenue going to come from?
Thanks, Jimmy, for that question. And I like the perspective you put it, surprises, because I think we are in for one huge surprise through this year's finance bill, because the additional revenue, like we mentioned, 2.8 trillion from 2.5 trillion, we are talking about 300 billion shillings that is supposed to come from additional revenue by the KRA. Ordinarily, that is supposed to be covered by the finance bill 2025. But again, casting that net wider, I think what the government is also looking at is trying to seal any revenue collection loopholes, so that not everything that is of the 300 to be collected comes from new tax measures, also the current tax measures, also the current taxpayers, and also widening the tax bracket. We are talking about trying to cast the tax net wider to cover also the informal economy, which has remained largely untaxed, and because of its informal nature. So it's a high time possibly the government comes up with measures and tax measures that are able to bring those that are not currently paying any taxes into the tax net, instead of going to the already tax-paying individuals. But all said and done, I think we are also on the lookout for on the provisions of the Finance Bill 2025 to see how much additional revenue it intends to collect, as well as any other tax reforms that are going to be introduced by the government, not necessarily as new tax measures, but to try and expand the tax base to bring more people into the tax bracket.
Right, so James, and of course, even as you answer this, maybe Kevin, you can be preparing your closing remarks. But James, there's a question, there's something that you touched on earlier on in your presentation, which is the cherry picking of some of the good elements that were in the finance bill. Are we likely to see a reintroduction of some of the other elements that were in the finance bill of 2024 into the finance bill 2025, with the argument that you mentioned previously that the government could argue and say, we've given you the good things, you might as well take these bitter pills so that we can be able to move on?
Jim, you know the problem with the Kenyan government when it comes to matters taxation. I think tax, like the issue of land in Kenya, is becoming very emotive. And I think the events of last year were evident how quickly things can turn nasty because of basically tax proposals being taken to manage, let me use the word manage, Kenyans. And it would actually be very unfortunate in my view if such a statement were to be made, because then by itself it indicates that there's no goodwill in the first place by the government extending good tax proposals. You know, it has always been argued that there's no country that can ever tax its way into prosperity. I think that's a fact. Tax is actually one of the biggest costs that any taxpayers in any jurisdiction face. And if there cannot be an easing of that, then it raises concerns. And you see, if you are to borrow even from the Trump administration with some of the things he was proposing, the proposal to even scrap the income taxes, you know, if you think about it logically, far much more tax is netted, not from direct taxes, but indirect taxes. And when I say indirect taxes, I'm talking about the value-added tax. I'm talking about excise duty. I think literally everything right now is subject to VAT, is subject to excise duty. If you look at in this room, any bottled water you have on the table is excise duty. If I'm an ABSA client, if I log into my app and I move some money, I'm paying excise duty. So you can actually imagine if the focus was to deal with increasing the capability of taxpayers to have more money in the pocket, and I think the velocity of how much they spend would still more or less achieve the same effect. I think that is where the focus should be. But statements that could evoke sentiments in terms of, we gave you this, so kindly give us this. You know, it's not a game. It's not a game of give and take. We are all stakeholders in this country. So I think maybe those should be utterances that I do not expect. And it's not really about managing Kenyans. It's about the reality on the ground in terms of the government seeing how it can support the business environment, for the businesses to grow, for them to be able to spend. I think if there is spend, the government does not actually need to be worried about taxing people heavily.
Mm-hmm. All right, thank you so much, James. Now, Kevin, even as you give us your closing remark, looking at the provisions in the budget policy statement, which is likely to inform the next financial year's budget, when you look at the amount that we are spending on recurrent expenditure versus what we are spending on development, when you look at the number of debts that are maturing in the coming financial year, what do we need to brace for in 2025? Are we looking at a more liquidity issue where we do not have enough liquidity in the market? And are we looking at the crowding out of the private sector by government borrowing?
Yeah, I think looking at the future in terms of the maturities that are coming up, the projection in the budget policy statement to go more into domestic borrowing than foreign borrowing. It creates a perception that the government is so much focused on sort of turning to the domestic market for its borrowing purposes, which we said comes on a trade-off that it creates a crowding out effect, so which might lead to maybe the lenders not being able to lend to so many businesses, which they deem to be riskier than the government. So I think in terms of that perspective, we expect sort of a tight interest rate market, which sort of has to be managed at a certain level by the government to ensure that also the private business are able to operate in the country. So I think for many businesses, it's to try and find any savings that they can make because possibly going forward, the cost of debt might become higher to the extent that many lenders might resort to borrowing from the government. But it also calls for a lot of fiscal consolidation, like the budget policy statement provides for, to ensure that such shocks are not being pushed over to the Kenyan businesses in the country.
All right, so James, just in closing, when you look at where we are in terms of the implementation of the national tax policy, is 2025-26 financial year the year that we actually get it right, even as you give us your closing remarks?
Jimmy, honestly, I don't think so, because we've been having this national tax policy discussion. The current Homa Bay Governor, Gladys Wanga, was the chairman, Finance and Planning Committee, and that was in 2021, 2020. So really, to be honest, I don't think we are going to see implementation of the national tax policy. And the reason I'm saying that is because if you look at some of the recommendations in the national tax policy is harmonization of some of these tax provisions to international best practice. There's already been deviation from that. There's actually very strong provision in the national tax policy that at least there should be a certain duration of time within which there should be no changes in tax provisions, and the recommendation in the national tax policy was a period of 5 years. So should we be having a discussion on finance bills and finance acts every year? The answer definitely under the national tax policy is no. The current CS National Treasury, when he came in, he said, I think we are basically past the era of having a financial act every year, but I think what they speak and what they do are two different things. So definitely not this year for the national tax policy. I think in terms of my closing remarks, I think it's what I mentioned previously, and the fact that the government seems to miss the point in terms of fostering business. I think that's where the opportunity lies. And I don't want to say necessarily that what Trump had suggested in terms of doing away or reducing the income tax is potentially the solution. But actually, if you look at even the medium-term revenue strategy, there is, I don't know if to say was or is, there is the intention to reduce the VAT rate. There is the intention to reduce the corporate income tax rate. And that only speaks to one fact. The government must have done its work to realize that lowering something like the direct taxes will be able to spur growth, whether it's at a corporate level or at an individual level. And the question is, why can't that be put to test? Because there is the velocity, and I will repeat, there is the velocity that is driven with consumption. Yeah, so those are my closing remarks.
All right, gentlemen, thank you so much for making time to be here with us, and of course, just taking us through this journey and what to expect. And something else that you, our Prestige customers, can expect is, of course, the Prestige Reward, which includes cashback when you use your debit and credit cards. That is for all spend categories, and of course, exclusive discounts from select merchants, where you will also be getting a cashback reward on all spend categories. And of course, this is a conversation that we'll keep engaging engaging in and of trying to make sure that you have the latest information, you're kept up to date in terms of what is happening in within the tax regime and how that is going to affect you or how that is going to benefit you. I've been your host, Jimmy Mbogo. Thank you for spending the last 2.25 hours with us. Even as we engage in this conversation, we'll be sure to catch you right here at the next one.